Hi, everyone. Thank you for joining today's office hours on Fed Watch. Will the Fed get stuck in neutral? Where you'll hear from Professor Jeremy Siegel, WisdomTree Senior Economist, Jeremy Schwartz, our Global Chief Investment Officer, and Kevin Flanagan, our Head of Fixed Income Strategy.
Well, thanks, Irene. Thanks everybody for joining. Professor, we were just talking about was there anything interesting today? But this week was very interesting. There's been a lot going on in the markets, but nothing going on at the Fed. But we'll love to take your response, your reaction, and hear where the Fed's going. But more importantly, where is the markets going with all that's been
Yeah, I
happening?
just see Microsoft. We got three earnings reports. Microsoft a little disappointing. At least I'm just looking over there and 4% down. But okay, so yeah, it was expectedly boring. So let me just quickly review the Fed. I think we should talk about DeepSeek and what that might mean in terms of all the markets. When the statement came out at 2 o'clock, they eliminated further progress. The wording, the Fed is making further progress towards inflation. Well, everyone said, "Oh my goodness, that sounds very hawkish," which it could be there. And also, they talked about solid labor market and all of a sudden, people said, "Oh my goodness, I think that this is turning hawkish." And then during the press conference, he kind of unwound it all. He said, "No, we just changed the wording and updated it. I still think we're in, restrictive territory, significantly restricted territory, which I don't even think we are. I think we're in mildly restrictive territory, as I've been saying for months and months and months, with at most 2 cuts and very likely maybe 0 cuts. What's going on? Listen, over the last month, since the last meeting, basically it's been good. And CPI is at or below expectations. I think we're going to get a decent number later this week on the PCE deflator. And I think we're going to get decent numbers on inflation early next year. Now, is that enough for the Fed to go? No, it depends on GDP. By the way, I don't know how many of you saw when that trade deficit came out at 8:30 today, and I said, "Oh my God, that's going to bring down estimates of GDP growth in the fourth quarter," and it did. The Fed dropped Atlanta Fed dropped almost 1 percentage point. It's one of the biggest drops I've ever seen on one data point. I think they're 2.6 or so. By the way, they're only back in consensus, which is 2.5 to 3 now. But all this stuff about +3 for fourth quarter just don't look like it. Not even in the high twos, perhaps. Now we'll see. That won't. We'll see basically what comes out. But that was a really a negative report on that. A big trade deficit subtracts, as you know, from the GDP. So, it's still a healthy amount. I'm not saying it isn't a healthy amount, and we'll see exactly how the job things come out. Let's talk a little bit about the DeepSeek event. I will certainly admit right away I'm not a tech expert, but I am an economist that tries to see the big picture of what that event might mean. Now, there's a lot of people that came out immediately with something called the Jevons effect. Jevons was an 18th century British economist who, when Britain was worried about running out of coal, and the railroads and everyone started using steam engines were using coal, he said, well, people said, "Oh, we're going to get much more efficient at using coal," which they did. And he said, that doesn't mean we're not going to use more coal, because it's going to be affordable to more people, and more people are going to buy machines that use steam and need coal, and the demand for coal could go up. Now, those who have taken Finance 101 recognize that as an elasticity of demand argument. I mean, right? You lower the price, and there's so much extra demand that the actual total revenue goes up. Now, you've got to be really careful about this. Now, thinking about this in terms of NVIDIA or high-end chips is wrong. It actually relates more to energy needs, perhaps. Now, I'm not saying, by the way, Gemma's effects is an if, it might. In other words, it might be that if AI, everyone, if AI becomes cheap enough, so many will use it, you'll still need more energy. You might even need more than you would before. It's like 120 years ago, if they, you developed the first internal combustion engine and it was 1 mile per gallon, no one could afford to buy it, it wouldn't be much gasoline demand. Then you make it 20 miles per gallon, oh, yeah, that's really efficient. I'm going to buy more gasoline. It was interesting. I was, Josh Brown, who I love, he was making an interpretation of that on CNBC, and he said, and he made a very interesting analogy, but I'm not quite sure he got it right. Now let's think back 25 years ago to the big bust. What was the first part of the big bust 20 years ago? It was in, JDS Uniphase, all the pipeline. And why? Because they discovered, multi-wave transmission, and all of a sudden you didn't have to spend billions of dollars. You could spend very little on getting the bandwidth that you needed. And all those companies totally failed. Now, there was also much more leverage in those companies. NVIDIA has zero leverage and all the rest. So that's why those others all went bankrupt. But actually, that pipeline could be almost talked about as what the utility demand is. Now, as far as NVIDIA is concerned, it's a threat. I mean, now, so let's talk about what kind of threat. Obviously, if basic AI can be replicated cheaply, today Alibaba comes out with something. We know that DeepSeek is making it open source so that everyone's going to have a field day. It's going to be commoditized. Now, what level? The question is, at what level of AI is going to be commoditized? The part that asks you, who won the pennant in 1958? Who cares? If we talk about the big expenditures on AI, we're talking about things like autonomous driving and inferential models that are a number of levels above that. Now, again, not being an expert, I don't know whether, this breakthrough is able to get into that high level. Some people say, no, they can't. I mean, that's where the real money is, right? I mean, autonomous driving is huge. Robots are huge. I mean, none of this, do they have the level to commoditize the AI for these high-level performances? You have to talk about, everyone talks about using AI. What are they using AI for? Okay, we can get rid of what? Our coding department? I don't know how many expenditures. They can do a lot better customer service at the lower level. I mean, I already know people that use them, they have what's virtual receptionists that do pretty well. But if you have a complicated question, can they do that? Can DeepSeek do that? I don't know. I don't know what the answer to that is. But that's the key question. Because obviously Blackwell has 90% margin. I mean, what makes NVIDIA is that ability on that margin. All right. Now let me go one step further and talk about the effect here on the stock market. Obviously, if middle to low level AI can be done so much cheaper. That's a huge gain to middle level firms and medium firms. Oh, I can, I'm not talking about, driving cars. I'm talking about doing the stuff that I need to do. It looks like it could be really cheap to do that. That's huge gains on profit for those firms that have nothing to do with technology. Now, we always knew that those firms had the potential to do well, but now they might be able to do well at a much cheaper expenditure than before. I mean, this could be a value shift. We talk about the narrative of AI and growth, which has dominated the stock market for 50 years. I don't say it's broken. I say it's gotten a blow to the head. The leader is still standing up and fighting there. He's not down. And he maybe won't go down, and maybe he'll recover and go up and say, hey, yeah, this is for the medium and low level stuff. That's not going to be the stuff. Now, for the high level stuff that really people will pay tens and hundreds of thousands of dollars for because they need that level of performance, can DeepSeek do that? I don't know. I don't know the answer. If the answer is no, then NVIDIA can still move on. But it is a blow, at least at the middle and low level, that area could be commoditized, which of course wipes out margin, which by the way is great for the U.S. economy. I mean, it raises productivity. I thought President Trump's response was absolutely appropriate. Listen, competition, Americans better, get on it and make sure that they're ahead. And Andreessen called it a Sputnik moment. Well, I lived through Sputnik. It's a little different, but I understand the analogy. I mean, there we were worried about first of all, then it was clear the Russians were ahead of us. This is not clear. It's that they're catching up. It was clear then that they were ahead of us. And by the way, we were all worried about carrying bombs in outer space and bombing down the U.S. And we didn't have anything like that, and shields and all the rest. So there was a lot of military, panic that had to do with that. So this is not that yet, although obviously there are military implications to be sure. But I'm saying is that this, is basically a positive for the world economy, the U.S. economy, but it's for the tech sector, it's a question of margins. I mean, stock market are built on capitalized profits, not just on GDP. And obviously the Mag 7 is built on capitalized profits and proprietary information and ability to be ahead, to patent and copyright information, and to stay ahead of competitors to become the world standard. And that all is more questionable now. Listen, it's not a dethroning. It's like, okay, what do I have to think about that? So that's I wanted to mention what my early take is on the developments in China on AI. Again, I admit right up front, I'm not an expert on, what DeepSeek can do. I have not downloaded it. I look at it. They're rating it 1, 2 on the boards for those people who put it through test, but they put it through standard information and computational tests. I don't know how high those tests go in terms of, the real ability to do some of the things that, the developers of AI are really trying to do. And particularly autonomous driving is obviously a huge thing. Can DeepSeek do that? Or now do we find out that we can get to that high level without having Blackwell chips, et cetera, and so on. So again, I think this is a really interesting development. And it's something that we should all watch. And I think it's certainly a positive development for us who, are kind of saying, "Oh, wow, and how long do I have to wait before, value finally turns?" I mean, and I'm not guaranteeing it does. I'm just saying this is one of those question marks that in my presentations I say that there are many others that have to be answered. Are firms getting the profits from the expenditures that they do? In terms of the cost savings, well, part of it depends on the cost. And do they have to buy the high end or not is certainly one of those questions, and margins are one of those questions. And so there are a lot of more questions that are going on. But it is a really interesting development to try to think about economically and think about what that might mean for the stock market, and a lot of that will be clarified. Going back a little bit to the current economy, we've had only a week or so of Trump. We really don't have what the tariffs are. There's threats, on the tariffs, and then they're pulled back at the last moment. We really don't know what the immigration policy is. All those are big question marks in terms of the economy. So particularly the tariffs, of course, is what people and by the way, the market still doesn't like tariffs. And no question that whenever just text a tariff, you get a downward blip on the S&P futures. They just, ooh, okay, they really don't like it. I mean, I'm a basic free trader. I understand the use of tariffs can be a good cudgel to induce fair trade and to induce opening up of markets and even rules on both sides of the ocean. But he said, bring it back to the United States. Well, our labor is 3 to 4 times as much money. So you're not going to. I don't see how you bring it back to the United States without raising the cost. Now, I mean, efficiency is higher here, but it is not higher enough, and that's why firms go abroad. And of course, there's a lot of things that we can't grow coffee beans in the United States. So there's a lot of things we can't even bring here. But in terms of manufacturing, it is more costly because we have a higher wage rate and a higher standard of living. Now we are more efficient, yes, absolutely. But are we more efficient to pay for those higher rates? Well, the answer is no. Otherwise, that's the reason why firms go abroad. So, at this particular juncture, the efficiency gains are not enough to bring it here and lower prices. It might create factory jobs, but again, we're pretty much at full employment at 4.1%. It isn't like a lot of people waiting around, oh, gee, I have no work, that they want to work. So, net tariffs, it's a very tricky thing. You can use it skillfully as a cudgel and get some gains. We don't know exactly, what is going to happen here. I do find it interesting that Trump tells Saudi Arabia to lower oil rates. Now, that's an interesting development. By the way, the quote, I want the Fed to lower immediately came really after, if the Saudis lower rate, then I think the Fed should lower rates. If the Fed lowers the oil price by increasing the production. Now, how is it going to get that? What kind of cudgel might he use? How pleased are the Saudis? I mean, the Saudis are waiting around with ideas about a global Mideast type of settlement where if Trump is belligerent towards the Saudis, then that's going to be harder to reach settlement there, which he wants to do. So there's a lot of conflicting gains and potential losses that we have here. Basically, our economy is still strong. I mean, again, a big tariff on there with retaliation is a negative. And I would probably say from a policy front, that's certainly the first big, the biggest thing that looms right now. The DeepSeek thing is a very interesting type of development that the market could suss out over time, and we're going to really see that. I mean, Microsoft and MS-DOS had an open technology. Apple chose a closed technology, and U.S. 90% of U.S. computers use the Microsoft protocols, and even Steve Jobs, admitted, yeah, I lost on that. So open technologies are good. They're for innovation, and they get wider use. We'll see exactly, what happens here. Listen, there's enough techies in the world that are, really skilled, and they're going to, I think these developments on what AI can do and cost, we might see relatively rapidly how that spins itself out in the world economy.
Well, Professor, there's a number of questions coming in live, and a number that were pre-submitted. Maybe, Kevin, I'll start with a few to the equity questions. You can figure out the Fed and rates questions. There's a few questions on valuations. One was framed as, are you worried about the average price of sales being twice as high? And a second one about the earnings yield compared to the bond yields, and worried about that.
Well, I was even tempted to write an op-ed piece, a stupid piece about negative equity premium. You do not compare a nominal bond yield to a real equity yield. So you got to compare the forward look. If you want to do the forward-looking P, forward-looking P is 22 on the S&P. That's a 4.5% real return. The real return is 2.1% on the 10-year real. So there's a positive 2.4% equity premium right now. There's no negative equity premium. They're comparing apples to oranges. It's a total. I mean, I've talked about this mistake for years, and it doesn't matter. People still write about it. And the Fed wrote about it, I think it was yesterday. Or Monday. So there's not a net. Now, that being said, that premium of 4.5 over 2.2, let's say that's a 2.34% equity. That's lower than average by about a point. So it is a little squeezed, but it's not negative. It's still positive. And it's been much more squeezed in the past. So, I mean, we have had a true negative equity premium in 2000 when the 10-year TIPS was 4.3% and the earnings yield was like 3.3. Well, we don't have anything like that today. So, yes, stocks are highly valued, but they've been much more highly valued in the past. So, that is not saying, oh my God, we've never seen levels like that. Now, on some metrics, which I reject as metrics, value of stock market relative to the U.S. GDP, I think is a very silly metric. Now, when you're talking about value versus sales, what you're really talking about is the upward movement of U.S. margins, world margins, but mostly U.S. margins on sales. So the profits are basically coming in. Now, what are margins being competed away? Well, a lot of it has to do with tech. A lot of it has to do with how how accounting is done with tech. Investment is expensed; it's not capitalized. So, in terms of you really should have a higher margin compared to what you actually do in those areas with a lot of tech investment. And tech has higher margins because it has so much proprietary. I mean, it's all built on proprietary copyrighted intellectual property. So, I mean, the predominance of tech is the reason margins go up, and that's why the sales to market value ratio is at an all-time high, or an all-time low, I guess, if you taking that ratio. Not surprising, but it has to do with the nature of what is number one and what they're huge. The margins in the tech industry are just extremely high, and that's why the commoditization of that is a potential problem to those margins going forward.
Professor, I wanted to expand, or hopefully you expand on this. I mean, here we are, Trump 2.0. This was the first Fed meeting in the new administration. We get a lot of questions. Some have come in here for this office hours as well. What, if any, kind of impact do you think Trump's rhetoric could have on the Fed, on Powell? Specifically, one question was that Powell, mentioned, as you did in your opening statement, of how we're meaningfully above still neutral. And is he becoming dovish to kind of placate Trump? So could you please put to rest any kind of these comments that we hear or concerns about Trump's impact on the Fed?
Yeah, I mean, I think, he will want to say as little as he can publicly. He wants to stick to the mandate that Congress has given him on what the Fed is. They will make decisions, I believe, that will be totally independent of Trump, because none of the people at the Fed need the job that they're in. It's not, gee, I want to keep my job, because they can always make 100 times what they're making it's almost a public service job. As I said, if Powell quits, he makes 1,000 times what he makes at the Fed. With no sweat. So, none of them have to, none of them have to bow down. Oh my God, I have to do that. None of them will have to do that, and I don't think they will. I really just don't think they will. Now, how they verbalize it is something else, and there's no conflict yet. The economy's rolling. The only conflict could come if the economy starts to roll over, and then Trump might say you should lower much faster. Now, than Fed wants to. At this particular juncture, I don't think they will. Now, will they, as a result of tariffs? Not until they see the inflation come through on the data. They're totally data dependent. They're just going to look at those year-over-year inflation. They're looking at sensitive commodity prices. They're looking at the economy. They're looking at the things that I have talked about week after week in my commentary about what you look at to see what the tenor of the economy actually is. So, I think the Fed will not. How they verbalize it is one thing, but I do not think they will be making decisions that will bend towards what Trump wants if they do not believe it is appropriate.
Perfect.
Now, on your view of the 10-year and the normal Fed funds, for people who may not be as familiar with exactly where your view of
I said the normal Fed funds somewhere between 3.5 and 4. We are at 4.33 now. And that could take years to get to. That's about it. The Fed, of course, puts their normal R-star Fed funds at 3.0, which is way too low. As time goes on, I keep on pushing it up. I say 3. Now I'm almost saying 3 3/4 to 4. We'll see. It's a range, as Powell has said. My view on the 10-year is that the 10-year should be 100 to 150 basis points above the Fed funds, which puts it in the 5 range. So I do not like long bonds right now. I think that the upside risk to yields is far greater than the downside risks. And downside risk on yields is could only be really caused by a recession, and that could be caused by some big disruption. Who knows? In some industries, or a real negative turn in sentiment. But none of that has occurred yet. None of that is, despite Trump threatening to fire people or this or that or that. None. There are lots of jobs available right now. No one is in a position to oh my God, job security worries are not up at this point. Obviously, if you're an illegal immigrant, then obviously your job security is much more up. We've talked about the fact that the agricultural industries and the construction industries, but they're a tiny part of S&P, are certainly at risk. And there's some bartenders at risk. There's some workers in Starbucks that are at risk. I mean, I know where some of the risks are. I don't know how long it's going to play out. We'll have to see, but that's at this point, the market is not worrying about that. The market is worrying about tariffs, somewhat. They react negatively to a big tariff announcement, and then they ease off once it's resolved one way or the other. But on balance, the market knows that open trade has a lot of benefits, and if you try to close that off, you lose those benefits.
Jerry, I just wanted to hop in. I know we're up against time. Do a little housekeeping, a nice plug for the professor. I believe tomorrow and next week we're having you on some additional office hours and talking about the Siegel models, and I just wanted to let people know and be aware of that so that we have solutions to what the professor's views are and sharing with us going forward. So please reach out, stay tuned. You'll be hearing more from the professor. Jared, back to you.
Yeah, there's a few questions about like where should you be, U.S. versus international, growth value. Somebody asked about the best yield to maturity. Those model portfolios that Kevin helps oversee on fixed income and that we do on equities with the professor's input, all useful guides. So make sure you check out the model portfolios pages to get some of those positioning points. We have some specific allocations that you could follow, and we can help you implement them all. So stay in touch with that. And good tease for that next office hours, Kevin. So I think great to do that. Professor, always great to get your comments. Not so much a Fed-driven call because it's sort of the boring event this week. But thanks.
Yeah, March, by the way, will be much more. We got the dot plots in March, and we got 2 months of Trump, not 2 weeks of Trump. So there are going to be a lot more. That will be a much more exciting meeting.
Well, very good. Thanks for your time, everybody. Kevin, Professor, always great to be with you.
Thank you.
Thanks, Jack. Thanks, everyone.